Last week, I introduced we stopped at kinds of business, sole proprietorship, or what we can also call sole trader. Today, before we proceed to partnership, let me just acquaint you with some of the things we did last week. So, source of funds of a sole trader. A sole trader can raise funds for the business through his personal savings. He can also borrow from friends and well-wishers. He can also have a credit purchase from ourselves. He can now come and pay. It's also a source of finance. He can also do that through donations from friends and relatives. It requires more capital to start as an advantage. Capital for a start. And it is very easy to establish. The business is very easy to establish because it requires more capital. A sole proprietorship owns his profit. He does not share his profit with anybody. Decision is also very fast. He takes decision alone. He does not consult anybody in the course of taking decisions. That's why it is very easy to operate. Another advantage of the sole proprietorship is that it is easy for a sole proprietor to withdraw his funds or assets. He does not even need to consult his family members before he does that. Unlike what we have in a private or public limited liability company, that a lot of people are involved, or even in partnership. He single-handedly formulates all policies. He does not take instructions from anybody. He's the boss of himself. He wakes up when he likes, opens shops when he likes, and flexible. Flexible in the sense that if he tries this business, if it doesn't work, he can introduce another thing. Such thing is not applicable in a public limited liability company. For instance, now Nigerian Breweries is into production of beer and malt drink. So you don't expect Nigerian Breweries that is operating a public limited liability company to begin to sell Indomie, to begin to sell noodles, or even cement, or even recharge card. It's not possible. But in a case of a sole proprietorship, it is very, very easy for the sole proprietorship to switch over to another business. Another advantage is personal satisfaction. It gives him satisfaction that he owns his business and he controls his business. He's the boss of himself. He takes decisions alone. He also has cordial relationship with his workers and customers because his customers are the key. That is the reason why he is in business. Let's look at disadvantages. Disadvantage because since he is the owner of the business, he takes decision alone. Losses and risk, he bears it alone. He does not share his losses or his risk with anybody. That reminds me our local balance, our local statement in our local balance, eat alone and die alone. He has limited financial resources. He does not have enough cash to expand his business because the funds needed for the business comes from him alone. He has unlimited liability. Having unlimited liability here means that his indebtedness has no limits. He can end up selling his personal belongings, landed property, motor vehicle, in order to offset his indebtedness. The business lacks continuity because the death of the sole proprietorship automatically, in most cases, marks the end of that business. He lacks specialization. He does not have the technical skills to expand himself and bring in innovations into the business because he is only one person doing everything. He is limited to expansion. we have successfully come to the end of sole proprietorship. And because you are undergraduates, you don't expect us in exam to ask you questions like define sole proprietorship, state the advantages and disadvantages. No. It's too elementary. Let me just give you a clue of what the question should be like if it comes in. It's not your assignment. I can come up with this particular disadvantage, lack of continuity, where I stated that the death of the sole proprietor automatically marks the end of his business. I can use it as sole proprietorship. Take for instance, Mr. Musa was a successful businessman who operated in Balogu market. And he died in 2015 after a protracted illness. And the death of Mr. Musa put an end to this lucrative business. Question number 1A, identify the kind of business Mr. Musa operated. B, the features. C, advantages and disadvantages of this kind of business. You can see this example now. It's not your assignment, so it's not your assignment. You can see this kind of question now. I did not mention sole proprietorship. It is your responsibility as a student to think in wealth and come up and identify the kind of business Mr. Musa operated. You don't need a prophet to tell you that it's sole proprietorship, because I use only one disadvantage to coin the entire question, is to coin a question that covers the entire topic. I can also pick an advantage to coin it. I just want to give you a tip of what the questions will be like. So from there, we move to partnership, which is what we have for today. What is partnership? In a nutshell, partnership is an association of 2 to 20 persons carrying on a business with the sole aim of making profit. Like I told you in sole proprietorship, if the aim is not to make profit, automatically the person is not in business. You are operating a non-governmental organization if you open a business without the purpose of making profit. Having said that, let's look at the features of partnership. A partnership has the following features. It is established between 2 to 20 people, as I said earlier on. The initial capital used in establishing the business comes from the partners. They tax themselves, they contribute and raise this initial capital that will be needed to establish the business. Their liability is limited in the case of limited partners, but in the case of unlimited partners, their liability is unlimited. Their liability being unlimited means that they can also be called upon to come and contribute money for them to pay their indebtedness. So invariably, your liability is not limited to your initial contribution. No, you can also be called upon to bring more money. Formation motives. The reason for establishing partnership is for profit making. Source of capital, like I told you earlier on, they tax themselves, they contribute money together. They can also raise money by plowing back profits. Profit they have made in the past, they put it into the business. They can also take loans from banks. We also have method of withdrawal. Unlike a sole proprietorship that can withdraw money from his business anytime he feels like. In a partnership, you don't do like that. You must seek approval from other partners in accordance with what you have in your partnership deed. Partnership deed is your laid-down procedure at the point of formation of the business. It has no board of directors. What you have there is partners. So let's quickly move to types of partnership. We have ordinary partnership. Ordinary partnership, we are referring to those people that play active role in the management of the business. We also have limited partners. By limited partners, we are referring to members in this category. They contributed money, but they are restricted from running the business. Having said that, let us move to kinds of partners. In kinds, we have active partners, those that are involved financially and also play active role in managing the business. We have dormant partners or sleeping partners, normal stroke passive, silent partners, secret partners. So let's quickly look at the source of their funds. How do they get money to start this business? Contribution from members. I've explained this before. They collect money, they tax themselves. They can also plow back their profit they have made in the past. Business. They can also borrow from the bank. They can also enjoy credit facilities from the bank. Let's quickly look at the articles of partnership deed. The articles of partnership, this has to do with some of those activities. They lay down procedures that will be guiding the partners in the course of establishing the business. They have to consider the name of the firm. They have to consider the partners, place of business, whether to establish the business in Kano or even in Lagos, based on the kind of customers they are looking at, based on the proximity. A lot of factors are put into consideration when you are considering the place of your business. Description of the nature of the business. What kind of business are you operating? Are you going to be into banking or into production? Are you going to render services? The amount of capital that each part is to contribute. You also put this, it must be stated in your partnership deed. The amounts or the role of each partner in the business, because each partner must have a role to play in the business. The method of profit sharing and the loss sharing. This is another area that can cause problem. So in order to avert this looming problem, it must be stated from the beginning how profit and loss shall be shared. Compensation, if any, the partner are to receive for service rendered to the business, because like I told you earlier on, some partners may contribute money, and at the same time, in the case of active partners, they also involve themselves in the day-to-day running of the business. So invariably, they must be compensated for helping to run the business, while at the end of the day, they also partake in profit sharing. The right of each business partner must also be stated. How long the business shall last before you can now wind up, think of winding it up. Partners' rights in the business, and so on and so forth. So you put all these things in writing so that there won't be problem at the end of the day. So let's look at advantages of partnership. The first advantage is that greater financial resources, because if there are 20 partners, so automatically 20 of them must make financial contribution. Unlike the case of a sole proprietor, only one person contributed the entire money required for the takeoff of the business. Combined ability of skills. In a partnership, since there are 2 to 20 people, they bring their wealth of knowledge together, their wealth of skills. So they have more capacity to establish and expand and grow the business, unlike a sole proprietor that only one man does everything. Continuity, greater continuity. Partnership has greater continuity when you compare it with a sole trader, because the death of one person, one partner, may not bring an end to the business. At once, they pay off the family and continue from where they stopped. Or they can also introduce a new partner who will now continue from where the other one stopped. Another one is ease of formation. Because they pool resources together, raising funds for the business is very easy. Decisions are jointly taken, so it is very easy for them to move on. They also take joint and better decisions. Two heads, they say, are better than one. In a situation, more than two persons are taking decisions for the entire organization, they may come up with better decision, unlike what is obtainable from a sole trader. Another advantage is the creation of employment opportunities. They help in creating employment opportunities for the citizenry. People around them, people within their operating environment can be employed, thereby contributing to the economic well-being of their host community and to our country as a whole. So let's look at disadvantages. They also have unlimited liability. I have explained unlimited liability before. So in unlimited liability simply means that their indebtedness is not limited to their contribution. If the company is going down, they can be called upon to contribute more money in order to take the company to the next level. Business is not a legal entity. It is not a partnership, is not a legal entity. So invariably, it has no legal backing. You cannot sue it, and the business cannot be sued. Decline in pride of ownership. You cannot say, I am the owner of this business, because the business does not belong to you alone. Bureaucracy leads to slow decision and policy making, because in a partnership, only one person is not taking decision. Unlike in a sole trader, only one person takes the decision. Here, decisions are jointly taken. So you cannot say that your will or your wish must reign supreme. You must consult other partners while taking decision. Disadvantage, they also have limited capital. These partners cannot get more capital through shares because they cannot sell shares. They cannot sell shares. Their money only comes through contribution from their members. Restriction on sale of interest. You can't just call another person to sell your interest. No. Even if you want to withdraw from the business, it has a laid down procedure. Other partners must be carried along. This is where we have successfully come to the end of partnership. So let's quickly move to joint stock company. What is joint stock company? In a nutshell, a joint stock company is a group of persons that have come together to invest their money in a particular company with a motive of making profit. We have two types of companies: unlimited liability company and limited liability company. By unlimited liability company, I mean that their liability can never be limited to their initial contribution or what they have contributed in the company. They can sell their personal belongings in order to offset the indebtedness of the company. And when I say limited liability company, it simply means that this category of investors, their liability is only limited to what they have contributed. They can only lose their investment. You can never call upon them to come and contribute additional money. Remember when we are treating sole proprietorship, I told you about people that establish company without the aim of making profit. We call these people limited liability company by guarantee. By guarantee in the sense that they are trying to promote science, maybe religion, arts, education. They are not out for profit making. That is why we call it by guarantee. And this kind of people, their indebtedness is limited to what they have guaranteed to contribute. It's a form of donation. If I say I will donate 10 million naira to Red Cross Association, if I donate that 10 million, any other thing that happens, Red Cross cannot call me to bring more money. I am limited to my donation. That is what I mean by guarantee. So we have two types of limited liability company. The first one is private limited liability company. By private, we have the number of people from 2 ranging to a maximum of 50. To a maximum of 50 people. These are the number of people required to establish a private limited liability company. Then the second one is public limited liability company, which has a minimum number of 7 people and has no maximum. It is infinity. A good example of companies in this category are those companies that are quoted on the trading floor of Nigerian Stock Exchange. Example, Guinness Nigerian PLC, Nigerian PLC, Unilever Nigeria PLC, Guarantee Trust Bank PLC, Zenith Bank PLC. All these are examples of public limited liability company. Then example of private limited liability company is unlimited and a host of others. Method of formation. Let's quickly go to method of formation. At the point of formulating this kind of business, there are some documents that are needed before you take off. Example, memorandum and article of association. And these documents state in clear terms what the company will be like and how they will relate with the outside world. It states the name, location, and objectives of the business. That is what you see in memorandum of association. And some of these things include the name of the company, location of the company, objective of the company, your aim for establishing the business, amount of the registered capital proposed, liability of the company, that is shareholders statements, and so on. So we also have article of association. In this article of association, we are referring to the regulation that is laid down for the internal rules and regulations. Here we are considering things like the duties, right, position of each member of the company, the method of appointment of directors, how dividend has to be shared, because if you don't state this, there will be problem when dividend has to be shared. You must state it in black and white. The method you must employ in the course of sharing your dividend. How general meetings to be held and the procedure. Method of electing directors, in most cases, or ideal, it is by voting. Voting based on the number of shares you have. And since it is by voting, if you cannot attend, you are allowed by law to send representative, and it is called in the financial world proxy. You send somebody that will represent you. That is proxy, P-R-O-X-Y. Method of auditing the company's accounts, whether you will hire the services of an external auditor to come and go through what the internal auditors have done. So all this must be stated. Another document that is of highly importance is prospectus. Prospectus is a document of notice, circular, advertisements, or other invitations offering public subscription or purchase of shares or the venture of a company. In those days, when companies are selling public offers, as a prospective investor, you will ask for their prospectus. Their prospectus is a document that will summarize within a short time what the company is all about, their financial status, their liabilities, and all the necessary information you need to know about them before you commit your money. We also have certificate of incorporation. Certificate of incorporation is issued by registering with the Corporate Affairs Commission. After that, you also try to obtain certificate of trading that will empower you to engage in your chosen business. So let's quickly look at features. Like I said earlier on, membership is between 2 to 50 people. Issuance of shares, they cannot sell shares to members of the public because it is a private company. But there is a process, there is a way to do it. You can source for a buyer from outside, and you now do what we call OTC, over-the-counter transaction. Transferability of shares is not easy. Transferability of shares is done through this method I call OTC method. Quotation. The company is not quoted on the trading floor of the Nigerian Stock Exchange, which means the shares of a private company can never be subscribed at the trading floor of the Nigerian Stock Exchange. Publication of account. They are not required by law to publish their accounts or to make their account public. They also enjoy limited liability. Each shareholder possesses limited liability, meaning that the shareholder can only lose his investment. You can never call upon him to come and contribute additional money. Let's look at features quickly. Let's look at features of public company. Features of public company, it has a minimum number of 7 persons and has no specified maximum. It's issued shares to members of the public. So invariably, members of the public are allowed to subscribe to their shares. So they can also sell their shares on the trading floor of the Nigerian Stock Exchange. Transferability of shares is very easy. You only call your stockbroker and give him a mandate order to sell your shares with your consent. Quotation of public companies. Their shares are quoted on the floor of the Nigerian Stock Exchange. So publication of accounts are also made public because it's a public company. So members of the public, whether you are a shareholder or not, you are entitled to know their financial position. They also enjoy limited liability, meaning that each shareholder is also limited to his initial contribution. Let's quickly look at advantages of a private company. They enjoy limited liability. I've explained all this before. Privacy, they enjoy privacy. They don't make their annual reports public. Continuity, the death of one man cannot bring an end to the business. They will continue the business even if they lose a member of the company. More capital, they also enjoy easy funds because since there are many, raising of funds will be very, very easy for them. They also enjoy legal entity, meaning that the company can be sued and also be sued. Disadvantages of private company. Taxes, in most cases, they are taxed heavily and they also encounter double taxation. Under shares, it is unfortunate that the company shares are not publicly subscribed. But if you want their shares, it is being purchased through what is called private placement. And it is not a guarantee. The owners of the company can say, we don't want you. They refund you your money. You cannot do anything. Unlike public company that is regulated by Security and Exchange Commission, Abuja. Private company is not regulated by anybody except they themselves. They have the right to say that they don't want you. So let's look at advantages of public limited company. They enjoy legal entity, limited liability. I've explained all this before. Look at Guaranteed Trust Bank, Zenith Bank, outside the Nigerian shore. Some of them have branches in London. They have branches in all the ECOWAS countries. Look at EcoBank PLC. So they have no limit to the level they can expand their business. Continuity is there. If a shareholder dies, in most cases, you and I will not know. The company will continue to be in existence. This is one problem Bashiru MKO Abiola had over all his business. Immediately he died because his companies were not publicly quoted. Immediately he died, so all his companies started folding up. But the same thing cannot happen to somebody like Aliko Dangote, who has made all his companies to be public. May God forbid, if Aliko Dangote should die today, his businesses will never die because it is publicly quoted. The continuity should be continuity. The company will continue to exist. The only thing that can affect them is maybe if the management fails to manage it appropriately. Adaptability. Adaptability, capital transfer, flexibility, all these are advantages. Disadvantages: quickly, double taxation, hard to establish. The attacks at times 2 or even 3 times. Very difficult to establish because large sum of money is required. No privacy. They have no privacy. They must make the account public. Non-flexibility, like I told you earlier on, they cannot switch over to another business. They must continue with what they have registered. Ownership are separated from managers, though in most cases, some shareholders may also be managers working for the organization, and they must also be paid for it. So let's quickly take our assignment for today's class. Question number 1. Barrister Balogu and Barrister Njoko graduated from law school in 2015. I take that again. Barrister Balogu and Barrister Njoko graduated from law school in 2015. And after graduation, they floated a law firm known as Balogu and Njoko Associates. Question number 1A. Identify this kind of business. Let me take the question again. Barrister Balogu and Barrister Njoko graduated from law school in 2015, and after graduation, they floated a law firm known as Balogu and Njoko Associates. Question number 1, identify this kind of business. A. Question number 1B, state the functions of this kind of business. Question number 1C, state the strengths and the weaknesses of this kind of business. State the strengths and the weaknesses of this kind of business. Because of your level, let me help you. When I say the strengths and weaknesses, is another way of asking you for the advantages and disadvantages. So you shouldn't be confused about that. Question number 2. Differentiate between a private limited liability company and a public limited liability company. I take that again. Differentiate between a private limited liability company and a public limited liability company. Submit all these assignments to Valentine Ekechukwu. Valentine Ekechukwu is one word. Ekechukwu is spelled E-K-E, not I, E-K-E. So invariably, there should be double E in between Valentine and Ekechukwu. V-A-L-E-N-T-I-N-E, E-K-E-C-H-U-K-W-U. Valentine Ekechukwu at yahoo.co.uk. Thank you very much, and have a very lovely day. Until we meet again, same time next week. Please stay safe and protect yourself. Good morning.